Okay, hello everyone and welcome to this session of the AIC. My name is Sean Keane and I'll moderate the panel discussion today. This afternoon's panel will discuss central bank policy making as we enter into the age of unwind. Our speakers will talk of the challenges faced in returning the practice of central banking to a more conventional footing. After this brief introduction, I'll invite each of the three panelists to make a short 5-minute opening statement about the main issues that they're focused on in each of their economies. Those statements will be followed up by some questions from the moderator and then a more open discussion of the main market issues of the day. As the most interesting questions generally come from the floor and not from the podium, we will leave at least 15 minutes at the end for extra questions. Now, one of the main challenges that I face today as the moderator has little to do with central bank policymaking or anything so elevated. Instead, it is how to introduce each of our three panel members and yet still leave sufficient time for them to speak and answer questions. It's not an exaggeration to say that our entire 50-minute session could be taken up reading the biography of any one of them. With the panel's permission and with an eye to the clock, I'll therefore offer some very brief bios of each of our panelists, and I would encourage you to return to the AIC website for considerably more detail. Dr. James Bullard at the end is President and Chief Executive Officer of the Federal Reserve Bank of St. Louis. Dr. Bullard is a member of the Federal Open Market Committee, the key policy-making body of the Federal Reserve. He joined the Federal Reserve Bank in 1990, and his research has appeared in numerous professional and scholarly journals. Dr. Bullard continues to act as a peer reviewer for many periodicals, and he currently serves as co-editor of the Journal of Economic Dynamics and Control. In recent times, Dr. Bullard has been a frequently heard voice in the public debate about quantitative versus qualitative policy objectives. He has added richly to the discussion about inflation metrics, output gaps, and monetary policy setting. He has warned in the past of the dangers of the United States falling into a Japanese-style deflationary trap, and he has supported the Fed's move into alternative policies and quantitative easing. More recently, he has indicated that he believes the US economy is gaining enough traction for the Fed to consider raising interest rates as early as late 2014. Dr. Bullard will be delivering a keynote speech on the prospects for US monetary policy at the AIC tomorrow morning. Glenn Stevens, in the middle, has been Governor of the Reserve Bank of Australia since 2006, and he's steered the bank through perhaps the most turbulent period in recent financial market history. Glenn joined the RBA's research department in 1980, and he has held various senior positions over the past 34 years, including heading the RBA's economic analysis and international departments, being assistant governor economics, and in 2001, he became deputy governor and member of the RBA board. Glenn is chairman of the Reserve Bank Board and Payment Systems Board, and he is chairman of the Council of Financial Regulators. He is one of only 2 Australian representatives on the Basel-based Financial Stability Board. In the charitable sphere, Mr. Stevens is chairman of the Financial Markets Foundation for Children and a director of the Annika Foundation. Glenn has been a visiting scholar at the Federal Reserve Bank of San Francisco. He is a member of the advisory boards of the Hong Kong Institute for Monetary Research, the Melbourne Institute of Applied Economic and Social Research at the University of Melbourne, and the Australian School of Business at the University of New South Wales. Earlier today, Glenn delivered a very interesting address on the outlook for the Australian economy and the global economy in 2014. Grant Spencer, here on my left, is the Deputy Governor and Head of Financial Stability at the Reserve Bank of New Zealand. The Financial Stability Department is responsible for formulating and implementing public policy to promote and maintain a sound and efficient financial system. Its major functions include foreign reserves, domestic liquidity management, analysis of financial markets and institutions, and developing and implementing public policy regarding financial institutions. Grant has held a variety of senior positions within the RBNZ, including those of Assistant Governor and Head of Economics. He's also spent the best part of a decade in senior roles in the private sector, and he has worked as a special advisor with the International Monetary Fund. As most of you will know, in recent months, Grant has spent much of his time crafting the RBNZ's new macro-prudential policy on housing that was successfully implemented in New Zealand in October last year. He will be delivering a keynote speech on that subject in this room tomorrow afternoon, and naturally we expect some of today's discussion to touch on this subject also. Now, what I'd like to do now is to invite the panel members to make a short opening statement on the issues that are most current to them. As we have two Antipodeans and one American, it might be good to place James Bullard's commentary in the middle. So perhaps, Glenn, we could begin with you, and then on to James, and then to Grant. And Glenn, I think most of the Australian-related questions that I received in advance of this panel focused on two areas. One was the strength of the Australian dollar in the face of a further Chinese slowdown, and the second was the concerns of offshore observers at the level of domestic house prices in Australia and the involvement of the investor community. Could I ask you to touch on those two issues, please, in your opening statements?
Well, thank you very much, Sean, for your introduction, and to Credit Suisse for the opportunity to be here. Most of what I wanted to say of a general nature about the outlook, I said in this very room, I think, just a couple of hours ago. So I don't want to dwell on that in any detail. Suffice to say, I think globally, last year the global economy was not quite as good as hoped, but nothing like as bad as many of us had feared, because most of the downside risks didn't in fact materialise, and I think prospects for this year are okay. In our own case, as many of you would know, the challenges we face are how to manage the coming off of a once-in-a-century boom in our terms of trade and associated massive expansion in capital spending by the natural resources sector. Now that's coming down. How do we try to foster a handover to other sources of growth in the economy, keep ourselves on a path that's near full employment and consistent with the inflation target? I think the prospects for us doing that are not too bad, but there's a tremendous amount of uncertainty for various reasons, some of which I went into this morning. On the things that you specifically mentioned, Sean, the exchange rate, well, we have pointed out that it was normal for the real effective exchange rate for our currency to be very high when our terms of trade reached a 100-year high, and we had a tremendous expansionary impetus from that. But as that abates, it would be normal to expect that the exchange rate, playing its normal balancing role of helping to stabilise the economy, comes down. It has come down somewhat. My personal feeling is that if the outlook pans out as we assume and expect, probably the long-run level for the Australian dollar is lower than the one we observe today. But the path that we take to get there, of course, is uncertain. The other question you raised was housing prices. It's a fairly common question we get, I think, from many foreign observers, because housing prices, they're certainly not cheap in Australia, particularly not for a country with so much space and relatively few people. What I can say about that, I think, is that for various reasons I won't try to go into now, there was a step up in the level of housing prices in the 1990s to what I suspect is a higher mean value. If we measure this in terms of price to income ratio, it used to be 3, now it's 4. We've been cycling around that value of 4 for about 10 years. So perhaps it's a bubble, but it's one of the longest lasting bubbles in history, if that's what it is. Our suspicion is that there is something fundamental that has happened here. That having been said, it is a question and an issue that we place a great deal of importance on. We watch very carefully, and we're at the moment, having had a rise in housing values of about 10% over the past year, we're taking every opportunity, including here today, to remind people prices don't only rise, they can fall. They have done. It's been seen not too long ago, in fact, in our memory, so be careful. perhaps that's enough from me to start. Thank you.
Thank you, Glenn. Jim, I've little doubt that attendance here today has been boosted by Fed Chair Yellen's comments last week. So to get that on the table and out of the way early on, perhaps in your opening comments, I can throw these two questions at you as well. First of all, did the market overreact to the 6-month comment and ignore all the other qualifiers that Ms. Yellen mentioned at the time? And secondly, in thinking about when to start raising interest rates, does the Fed have a minimum level of growth in mind, say perhaps 3%, that would be necessary for you to start raising interest rates, or is the issue very much one of inflation control from your perspective?
Well, thanks for having me. It's great to be back in Hong Kong and back at this conference, and I'm looking forward to participating today and tomorrow, and maybe talking to some of you all. I know that you track the U.S. economy fairly closely, but let me just remind you a little bit about what's been going on. The second half of last year came in pretty strong for the U.S. economy, over 3% growth. We had good jobs figures, and unemployment declined pretty rapidly. And that's what enabled the FOMC to take a decision to taper the QE program beginning last December. So now we're on this taper track, which has been reducing the pace of purchases slowly over time at about 10 billion or at 10 billion per meeting, which we reaffirmed at the most recent meeting. A lot of people ask, well, what would it take to alter that pace? My response to that is, if you look at last summer and the taper tantrum from last summer, one message from that, you might take many messages from that, but one message was, it's a big deal if the FOMC decides to alter that pace in either direction. So I think the committee would be very careful about playing that card and only play it if we really felt like the economy was moving off track in a significant way from what we had previously expected. So we reaffirmed the taper decision at the last meeting, and then we also were coming up against our thresholds on unemployment and inflation. We had previously said we would not consider raising rates at least until unemployment got to 6.5% or inflation got to 2.5%. And it turned out to be the unemployment part of that was the more significant constraint. Now, my view on this is those thresholds worked very well. But we knew the day would come when one of the thresholds would be breached, and that day has not quite come, but it looks like it's close. And so it was time to put the thresholds away and replace that with more qualitative language, I would say more standard central banking language about how we would make judgments going forward. The Chair Yellen, in her remarks, did talk about a considerable period, put the 6-month moniker on it. I have already said that I thought that wasn't very different from the expectations I saw from people like you all in this room. So I don't really think it was too much of a surprise. She did a good job of putting qualifications around that. I think it is going to be a judgment of the committee about how long to wait. It's very much a situation where we're going to look at the data. It is a state contingent policy, not a date contingent policy. So it's not like we're putting out a calendar date. We're going to be looking at the economy and seeing what happens. I think the biggest thing you have to keep in mind about the U.S. economy is that unemployment has come down more quickly than most expected. Some of you might remember last summer, Chairman Bernanke at the June press conference was saying that he didn't think we'd be to 7% unemployment until mid-2014. Well, we got there by the end of 2013, and now we're below that, and it looks like we're poised to go lower from here. So this has happened more rapidly. A lot of people on the unemployment question will cite labor force participation, so I will refer you all to my most recent speech on this question, the rise and fall of labor force participation in the U.S. The message of that speech is to say that I think most of the labor force participation movements in the U.S. are part of a demographic trend. and that therefore you can interpret the unemployment rate as a good indicator of the amount of slack in the labor market. And so I would take signal from the recent drop in unemployment in the US that indicates that the economy is improving and will continue to improve going forward. I think we'll get down below 6% by the end of this year. So I think we're in good shape in the US both for growth and for improvement in the labor market. The most recent data for the first quarter looks a little bit soft. There's been a lot of weather talk in the US, and I can attest it was snowing in St. Louis just yesterday, which is a rare thing for the middle of the country. So weather has been a factor, but I think as that comes out and we go through the spring, I think the outlook for the US is quite good, because the things that have been a drag on growth in the most recent years, last 2 or 3 years, have all dissipated and are no longer as big of factors as they were. And for that reason, I think we're set for a pretty good year in 2014, despite the spat of weaker data just in the January-February timeframe. So I'm going to stop there and turn it back to you.
Thank you, Jim. Grant, that won't surprise you if I say that the majority of the questions that I received about New Zealand related to the strength of the New Zealand dollar and the ability of the New Zealand economy to comfortably operate at these levels. So in addition to your opening comments about macroprudential policy, perhaps I could ask you to touch on the currency issue as well.
Happy to do that. What I thought is that I would mention the 3 main factors that I think will be key drivers of financial markets in this region over the next 2 to 3 years. I think the first one is the normalisation of US monetary policy, and that Jim referred to the taper tantrum last May. So obviously that initial transition was a little bit disruptive, but I think since then things have smoothed out. I think the adjustment is quite orderly in terms of the impact on countries in the region. And most central banks in the region are probably viewing it as reasonably benign, except for maybe 1 or 2 exceptions. But I think there's a fair way to go. So during that time, over the next year or 2, I think there could be some disruptions resulting from that normalisation. And so I think countries really need to use this softer period to maybe, get their policies in order, because I think it won't all be smooth travelling between here and normalisation. The second main factor, I think, is the reforms in China coming out of the 3rd plenum. These are very broad, far-reaching. They're going to be affecting Chinese policy over the next 5 or 6 years. And obviously, they're very positive for long-term growth prospects in China. But I fear that there'll be some point during these reforms where there will be disruption, because there's always these complex interactions of reforms, and we've seen them in other countries, including my own country. It's very hard to get the sequencing just right, and particularly when you're talking about financial deregulation, opening up the capital account. I think you could see significant periods of turbulence in financial markets, potentially also affecting the growth in China, real flows, trade, commodity prices that would hit Australia and New Zealand. So I think that's the second factor. The third one, I think, is Japan's quantitative easing. I think it's increasingly apparent that the structural reforms, they're having trouble getting traction with those. And so the risk is that there'll be increasing reliance on the quantitative easing, the first arrow. And if that accelerates, then there's a potential for more capital flows into the region and weakness in the yen. Now, to date, this hasn't been as big a factor as maybe people expected, but I would think with the normalisation of policy in other countries, in the US and some countries such as ourselves who are actually starting to tighten policy, then it's a greater likelihood that we will see capital flows out of Japan into the region. The return of the Mrs. Watanabe in particular and the Uridashi flows, which made it our life very difficult back in the 03 to 07 period. And so we would make it more difficult if that happened, but I fear it's quite a high probability. So those are the three factors I would mention, and we can potentially come back to the New Zealand dollar.
Okay, thank you. Okay, I'd like to loop back now with some questions. First of all, touching on the topic of today's panel discussion about policymaking and its possible return to a more conventional footing. And the question I'd like to ask the panel is, has the practice of central banking been permanently changed by the events of the past 6 years? And can policymakers ever return to their more conventional past? Glenn, the RBA is perhaps one of the least changed central banks in terms of its operational activity. So perhaps we could start with you before giving Jim and then Grant an opportunity to comment also.
Yeah, well, I think in some respects, the practice of central banking has changed, at least persistently. There's persistent and there's permanent. Permanent's a long time. I think there are some persistent effects. Not so much in our case. We expanded our balance sheet a great deal temporarily for a few months, but within a few months it was back to normal. That's 5 years ago. So we are happily in the environment where we didn't reach the zero lower bound. We're targeting inflation. Interest rates are positive. They go up and down, but in some sense that's sort of a bit normal. Nonetheless, because of the global situation, we're doing all this around certainly a lower mean value of interest rates and a higher exchange rate perhaps than otherwise. So it has had an impact. I think more generally, there are certainly long-lasting effects on the practice of central banking, if only because the effects of the crisis on economies has been very long-lasting. There are major economies whose real GDP today is still smaller than in 2009. The US isn't one, but there are one or two other members of the G7 where that's the case. That's a very profound effect. The effect on government fiscal positions of the crisis and the loss of revenue and the requirements to assist banks, in many cases at considerable cost. This is a very persistent effect on the budget balance and on the debt trajectory. And I think the practice of central banking, it's within that setting that we've seen the Fed first, well, the BOJ actually was first, then the Fed and the ECB go into territory that they hadn't been in. It looks like the Fed will be the first to be able to stop the asset purchases, but even there's a big balance sheet to gradually wind down, and that'll take, I imagine, some time. So my guess is eventually things will go back to what we used to think of as normal, but it takes quite a long time. So the practice of central banking is possibly not permanently, but certainly persistently, unavoidably affected, I think, by just the nature of the events that we've seen.
Thank you, Glenn. Jim?
Yeah, I guess I agree with that. You got this very persistent effect on, if you just look at it from the perspective of when is the balance sheet going to get back to normal, when would you get off the zero lower bound? It's going to take a while for all that to dissipate and get back to a level of interest rates that you might have seen, in the mid-90s or mid-2000s during an expansion. So that part is going to take a while, but there are other aspects of the crisis and how the crisis affected central banking. So maybe I'll just devote some remarks to asset bubbles. The U.S. had 2 asset bubbles in 2 decades. We had the tech bubble in the 90s, and we had the housing bubble in the 2000s. And the general consensus seems to be that the tech bubble ended in a more benign way, not completely benign, but a more benign way, and that the housing bubble was an unmitigated disaster. And so I think ever since the irrational exuberance speech, policymakers have been wrestling with what to do about these kinds of situations and how to use monetary policy. And because the crisis was so large in the U.S., and caused this legislative reaction coming through the Dodd-Frank Act, that's just a permanent change in central banking. We're expected to be a guardian of financial stability in a way that was not true before 2007. And when you're sitting in 2006 or 2007, you might have told a story about bubbles that would have been informed by the tech bubble experience, where yes, these prices look out of line. Yes, they could probably crash, but we can manage the crash. That was the sort of former Chairman Greenspan's line, and that just didn't work for the housing bubble. So now you've got a central bank that's much more involved in the regulatory structure, a much broader mandate to look across not just banks, but non-bank financials. You've got a financial stability council. You've got many more requirements, a heavier regulatory environment, generally speaking, and a bigger role for the central bank in that regulatory framework. So I think that's just a permanent change that's not going to go away. And so that would be the main thing that I would cite from the last few years.
Thank you, Jim. Grant?
My comment would be very similar to Jim's. I mean, I'm thinking about our own framework. Very little has changed. One thing that has changed in our policy targets agreement in the past couple of years is to introduce financial stability as a consideration that monetary policy needs to think about. The primary objective is still price stability, but financial stability is something that to be considered. So in the current round of tightening, where we've just started to tighten policy after 5 years of very low rates, really the round we went through was very similar to monetary policy rounds that we've had over the past 10 years. Price stability is the objective, and the policy path is basically engineered in order to target 2% inflation over the medium term. But so fundamentally, I don't think things have changed, but I do agree with Jim that the key consideration, when you look around internationally, I think the main change in policy is that people are giving more consideration to financial stability. And of course, in the previous boom, there was the big debate about do you lean against asset bubbles or asset price strength, and there was the clean versus lean debate. You either wait for it to blow up, to pop, and then you clean up the mess, and so you don't lean against it, or the alternative view is you do lean against asset prices. And I think post-GFC, there's been a shift towards that latter view, where it's considered appropriate to lean against asset prices, even though CPI inflation itself may be reasonably benign.
Thank you, Grant. I'm going to ask one more question, then I'm going to open it up to the floor. So if you do have questions in mind, please start thinking of them now. The last question I'm going to ask is related to some comments that Dallas Fed President Richard Fisher has made. Richard Fisher's argued that the job of the Federal Reserve is to focus its attention on the US economy, and it is not to set monetary policy with the rest of the world in mind. Now, given the enormous impact that the Fed's decisions have in every part of the world, often via the forex markets, is such an approach reasonable in the modern era? Grant, I'll start with you because the RBNZ's certainly been impacted indirectly by Fed policy through the currency line, as has the RBA. And then perhaps you could take that one before passing it to Glenn, and then we'll let Jim finish off.
Well, clearly, US monetary policy is the dominant monetary policy force in the world. It has an impact. The quantitative easing, I think, did weaken the US dollar. It tended to, the risk appetite, a lot of funds was attracted to currencies like the Aussie and Kiwi. And, you know, that was not something that we welcomed. But when you look at the proposition that you know, does the Fed consider the rest of the world? I think clearly that they do consider the rest of the world. If you talk to the Fed, they have a big international department. They run all they trace the effects of their policy on the international economy, not just on the domestic economy. And that's totally appropriate. I think at the end of the day, though, when trade-offs come up, where there's a trade-off between global growth or US growth, you know the US is going to put its weight more on the US than on the rest of the world, just as other countries would put their weight more heavily on their home country. So it's understandable that they would take that approach. But it doesn't make it any more welcome if you're on receiving it.
Glenn.
Well, I think Richard's absolutely right to say that the Fed's job is to set US monetary policy for the US. The fact is, every central bank in the world has a national mandate. The only exception is the ECB, which has a region mandate. But the rest of us are a creation of our national legislature. We've been given a national set of objectives. And so far, and I suspect it will be a very long time before there's ever some kind of international arrangement where major central banks were to be given some kind of global mandate. I don't think I'll ever see that. So the Fed really has no choice but to follow the mandate that the Congress gives them, and that's what we're all doing. That having been said, my observation would be that the Fed is acutely conscious of potential spillovers, and a feature of the G20 meeting we had in Sydney a month ago was the way in which Janet Yellen took great pains to spell out how the Fed thinks about this. And I think what they can do is follow their mandate, but communicate as clearly as it's possible to do, take account of all the feedbacks, some of which come back to the US itself, of course, so they internalise that, and I think they do that. And I think she communicated that message very effectively, and that really is all the rest of us can have any right to expect, to be blunt about it. Yes, when the Fed changes course, stuff happens. It's always been so. And it always will be. That's just how it is. And I might say, to echo something Grant said, the same is true for the Bank of Japan or the ECB. You know, the BOJ will shortly be putting more cash into the global economy than the Fed, if the Fed stays on the current path. People don't talk about that, but I've never understood why not, really. It isn't just about the Fed. These spillovers happen from other major countries too, and for that matter, spillovers go back to the major countries from the emerging world. I don't think there's any doubt that the collapse in investment in Asia post the crisis, which still hasn't recovered, by the way, and their desire to shift their current accounts a long way towards surplus to accumulate foreign currency reserves, advised to do so by the IMF. I don't think there's any doubt that that had an effect on the global cost of capital and on the United States, frankly. One of many effects. So spillovers go in lots of different directions. They don't just come from the US to the rest of us. Some spillovers go the other way.
Jim.
Well, first of all, we love you all. I would never want to disagree with my great friend and colleague, Richard Fisher. He's absolutely right. The job we've been handed by the Congress, and we are a creature of Congress, is a national mandate for maximum employment and stable prices. So we try to deliver on that as best we can. It so happens that my speech tomorrow is on international policy coordination, so I'll give you a preview of exactly that. I think the key question here is, yes, we have national mandates. Could we do better on our national mandates by all the central banks sort of joining hands and working together? That's how I would interpret the literature on international policy coordination. And the standard answer to that is, yes, you could do a little bit better, but the gains would be small. And so the story has been that it would be hard to get all the central banks to do this. And even if you could get that done, the gains from that would be relatively minor. And so it actually does not work out that badly when each country pursues its own self-interest with respect to monetary policy. The global equilibrium isn't that far from the global equilibrium that you would get if everyone perfectly took into account all the spillovers across the whole world. That's the traditional view. There is another view, which is an alternative view, and I'll spell this out more tomorrow, but the alternative view is that, you might ask, well, why is this debate heating up now? And I think there's a very clear reason why this debate is heating up. It's because of unconventional policy in Japan, in the US, and even to some extent in Europe. And when there's unconventional policy, sort of those previous models go out the door because now you're sitting here in Asia, you're not that sure what's going on in the US. How should I evaluate that unconventional policy that's going on in the US? And the key aspect of that unconventional policy is, can the central banks, the US central bank, still maintain price stability in the same way that they've always maintained it in the past, or are they taking way too many risks? Maybe on the high side, you might have a view of quantitative easing. It's going to be very inflationary in the future, so they're taking way too many risks in that sense. Or on the low side, maybe QE isn't that effective, or forward guidance isn't that effective, and the central bank is not able to stem a decline in inflation from the way that they used to be able to. So I think it's just very hard to read the signals when you're in an era of unconventional policy and you're trying to evaluate the major central banks in this type of era. And that's why this debate has heated up more. So it's possible that depending on your view of unconventional policy, that you could tell a story that the world equilibrium is too volatile now because the Fed isn't doing what it's supposed to be doing. Now, I'm here to tell you we are doing what we're supposed to be doing. And the unconventional policy is a good substitute, or as good a substitute as we have, given that we're at the zero lower bound and we still are trying to achieve our objectives despite not being able to move our nominal interest rate around in the normal way. But there's room for debate on that issue. There's clear room for debate on both sides, on the side that we're being sort of way too aggressive, or on the side that what we're doing is completely ineffective. And you hear all kinds of commentary in both directions. And I would maybe just a general point to end this up with, that's just creating a lot more uncertainty on this whole question than there would have been with the traditional view of this issue as it's spelled out in the literature, that the gains to international policy coordination are small. So anyway, more on that tomorrow morning.
Thank you, Jim. Okay, let's open this up to some questions from the floor. If you have a question, please raise your hand and we'll get you a microphone. Please state your name and where you're from also.
I'm Stuart Winchester with Alliance Global Investors. And I'd be interested to hear Dr. Bullard's comments on the extent you have any concerns about zero interest rate policy, how it affects risk behavior, and as an extension of that, how it impacts, potentially negatively impacts savings behavior.
On the risk-taking behavior, I think an important part of the debate in the U.S. has been Governor Stein, Jeremy Stein, on the Board of Governors, who has given speeches recently, but also gave a speech last year about this time in St. Louis. And his basic story was that the Bernanke doctrine is that we're going to use macro-prudential policies to take care of excessive risk-taking. He portrayed the financial markets as a big haunted house. He didn't actually use those words, but that's kind of, you had to go around the haunted house and look at all the rooms and see if there were any excesses developing or any ghosts in any corners of the haunted house. And maybe it wasn't realistic to say that you'd be able to write a new regulation or you'd have some kind of regulatory response to that excess in a timely manner. And so his bottom line on that was maybe it would be better just to raise rates in that situation because that gets in all the corners of the financial market. That's his story. So that kind of story is that there's an advantage to interest rates being a blunt instrument. It gets in all the corners of the haunted house.
Next question.
Wait, I want to finish.
Oh, I'm sorry, Jim. I apologize.
I want to push back against that just a little bit. The two big bubbles that we had in the US, they weren't a mystery. They weren't in some corner of the haunted house. They were on the front page of the Wall Street Journal every day. The tech bubble, everyone knew the tech bubble. The housing bubble, everyone knew. Oh, you pick up an issue of The Economist that said housing bubble in the US. So it wasn't a matter of having to find the bubble. It was right in front of you. The question was what to do about it. Should you raise rates or not? And so I think that's, so my view is a little bit different from Governor Stein's, I guess.
Thank you.
Thank you. I'm a reporter from Market Watch at Dow Jones. Yesterday, Charles Plauser said he expected short-term interest rate to reach 3% at the end of 2015 and 4% for the end of 2016. Did you raise your projected interest rates?
So this is a question about these dots in 2016. So I'm here to tell you my dot did not change. My dot is the same, but that's because my dot is at, I have the output gap being closed in 2016. I have inflation at target in 2016. So I put the funds rate at a sort of normal level in 2016. That's the way I thought about it. Not all my colleagues have the same view. There's a couple stories you could tell about why rates might still be low at that point. One is that there would still be headwinds affecting the U.S. economy. Another would be that global real interest rates are relatively low and have been low for a long time, a decade or more, and possibly will still be low in the future. And for that reason, even when you're at a neutral funds rate, that neutral funds rate maybe wouldn't be as high as what you're used to thinking of from the 80s and the 90s. So that would be another way to think about it. The third way to think about the dots in 2016 would be that it's a Woodford-type policy. The Woodford-type policy is Michael Woodford from Columbia University. That policy would be you're staying low because you're making up for the period when you were constrained by the zero lower bound. That's a less popular story among committee members, as far as I can tell. But there would be three ways to think about it. But for myself, my dot is at sort of normal levels, and I did not change it.
I think we had another question over there.
Cas Burns from Reverend Howard. Question with regards to returning to conventional policy. Dr. Bullard, what do you think has to be in place for the Fed to thinking about starting hiking interest rates?
I'm sorry, could you repeat that a little bit?
Which type of conditions do you think would have to be in place for the Fed to think about starting to hike interest rates?
Well, I think we have to make more progress on labor markets than we have so far. I think in my opening comments, the main thing that's happened in the U.S. is that unemployment has dropped faster than many were expecting. But still, we're at 6.7% unemployment. That's pretty high by U.S. standards. It's going to have to get better than that. Other aspects of labor markets are going to have to improve. The other aspect in the U.S. is inflation's pretty low. Our preferred measure, year over year is just above 1%. That's quite a ways from our target of 2%. Now, I have worried about low inflation in the U.S. in the past. I think you can tell a story that has bottomed out. It was kind of declining, but over the last 9 months or so, it has bottomed out. And I think it's poised to go back toward target. My forecast has it going back toward target. If that doesn't happen, that'll weigh as a factor on the committee. So I think that'll be an issue. And we'll have to make a judgment call in looking at both those things in conjunction with financial stability concerns.
My name's Adam Sapper, I work for an investment fund here in Hong Kong. Fiscal versus monetary. Why do you continue to give Congress a pass?
Giving Congress a pass. I think Chairman Bernanke in particular was very good about insisting that Congress get its fiscal house in order. Many members of the committee have repeatedly said that this is critical for the future of the U.S., including me. So I'll say it again, it's critically important for the future of the U.S. that we get our fiscal house in order. This means that you can't be looking over 10, 20, 30 years and looking at pictures where everything's going to blow up. So I think to reduce that future uncertainty, Congress should adopt a plan and the President should sign it that would give a reasonable expectation about how those expenditures will be handled going forward and how taxes will be handled going forward. To leave that all out there unsettled is just introducing a lot of uncertainty about the future of the nation and to some extent the future of the world, and you don't want to do that. So I'm very much for, so I don't feel like we're giving them a pass. I feel like we've tried to insist on that. We do have better coordination in Washington right now than we've had in a while, so there does seem to be a little bit of progress on that issue, a little bit less brinkmanship than we've seen over the last 2 years, and I do think that's an improvement from what was a bad situation even 6 months ago.
I think we've got time for one more question. Somebody at the back. We haven't had too many from the back.
Hello, Geoffroy de Carbonnier from Nextworld Group. In Australia and New Zealand, do you see any spillover effect from what's happening in China? Given either capital flowing out or in for you from and in China?
Well, in terms of pressure on commodity prices, this is very significant for New Zealand. It's one of the key drivers in terms of growth in the economy, together with the Christchurch rebuild and the housing market. So on the trade side, commodity side, demand from China is crucial. It's a big driver. On the capital side, we don't really have good statistics, but there is quite a lot of money coming from China into the property market. The evidence is mainly anecdotal, but funds are coming in from Asia and China in particular into commercial property and residential property and property development as well. So there's a lot of debate about how significant that is as a driver vis-a-vis domestic factors, but it does seem to be there.
Not much to add to that. I think experiences are probably similar. My observation would be that on alternate days, financial markets worry that China is slowing down, and so we see our exchange rate depreciate and so on. And then the next day, well, maybe China will stimulate. So take your pick, depending what day you ask the question. But I think much of what Grant said I'd identify with.
Okay, unfortunately that's all the time that we have available today. I'd like to thank RBA Governor Glenn Stevens for his address earlier on and for participating in the panel today. I'd remind you that Dr. James Bullard will be addressing the AIC tomorrow at 8:20 in this room, and that Grant Spencer from the RBNZ will be speaking about macro-prudential policy here at 2 o'clock tomorrow. So on behalf of Credit Suisse, I'd like to thank our three panellists today for their comments and their participation in the 17th Asian Investment Conference. Please join me in thanking our guests.
Well done.